Well, back home with my regular setup, so I don't have to worry about doing it in Microsoft Word. Everything is good and clean again. I'll be putting the telecom video up this week, understanding telecom for the applied level subscribers. I've got T-Mobile's 10K, I've got Verizon's 10K, AT&T. What's going on, guys? Coming up on a month. You haven't got your 10K out. There should be some kind of deadline here. So I'm going to wait till Wednesday. If they don't have their 10K out by Wednesday, I'm simply going to move on. I don't really need AT&T. I can demonstrate enough with T-Mobile and Verizon. Spoiler alert with AT&T, they're not going anywhere. So it's not as if you're going to miss anything. It's pretty much an uninvestable company overall. That doesn't mean there isn't a trade. It just means it's not really an investment. I'll talk about that a little later. Let's look at our yields. Money market, all well behaved, pretty much as it should be all the way out to the 3-month, indicating no possibility of rate cut in March. Capital market still doing a bear, and I'll spell it out, a bear steepener on this one. So we should see the money market to the capital market inversion improving, and it has the 3-month, here it is, the 3-month of the 10-year up 13 basis points, still inverted 114, Canada at 141. And the market, I keep thinking it's time to move on from rates. There are more important things. But the market responded this week. I'll show you how it responded to each of the inflation reports and how it responded to one Fed speaker. And then how it completely just ignored retail sales. That retail sales was ugly. And it was like, doesn't matter. Rates. That's all that matters. So I was about to put rates in the back seat, but they're still in the front seat. In fact, I'd almost slide them from the passenger side back over to the driver's side based on how the market responded this week. SOMA runoff, it was actually increased by 71 million rather than any runoff, nothing maturing. So we're still sitting at 7 trillion. Next week, will we see a 6 handle? I keep saying we'll see a 6 handle next week, and the market's just saying, oh, is that what you're waiting for? Well, not going to happen. Balance sheet up 2.54 billion, small moves here, 7.633. Looking at money market funds, and I got something to say here. 6 trillion, decreased by 4.29 billion, still sitting at 6 trillion. For retail, when I say retail and institutions, retail is people like you and me. Institutions are pension funds, endowments, foundations, corporate treasuries. So when we look at a balance sheet, we see cash and cash equivalents. That's not just sitting in cash. That's money market securities. So for retail, in government money market securities, down 2.3, but up in prime. So it looks like they're staying, but reaching for some yield out of prime. Prime is got some credit risk to it. For institutions, same pattern. Down on government, up on prime, but on net they're down. Now over the past week, I've heard, I think 3 or 4 times on Bloomberg they were talking to different, the head of equity strategy for this bank, or head of fixed income for that bank, and all of them, I shouldn't say all, but a good number of them were talking about money on the sidelines. There's $6 trillion sitting on the sidelines. Well, if you have a playing field, and let's call this the equity playing field, here are the sidelines. You get the reference, your players are on the sideline. They think, well, the money market funds are on the sideline. If you have this playing field here, and this is fixed income, this is bonds, you have your players on the sideline, and they're making the case that that is money market funds. What they're not mentioning is there's another playing field over here called money market funds. $6 trillion is not sitting on the sidelines. When we think about corporate treasuries, cash and cash equivalents, that money never belongs to the bond market, never belongs to the equity market. It purely just belongs to the money market. That's why it's called a cash equivalent. So corporations keep a lot of money in money market securities. Investors. Most optimal portfolios have some kind of cash component, anywhere from 2% up to 5% at all times. That's always sitting in money market funds. And as the money supply increases, the amount of money in money market funds increases proportionately. The bigger GDP gets, the more money that sits in money market funds. That doesn't mean more money is finding its way in. It just means the nominal amount is going to increase in proportion to all nominal amounts. So over time, we would expect the balance in money market funds to increase at some growth rate. So it is not true that there is $6 trillion on the sideline, because some of it belongs in the game, in the money market, is playing in the money market field. But there is some money, some money in money market funds that really is there for a period of time, and then it's going to leave. Some of it belongs to the equity market. Some of it probably belongs to the fixed income market. But we can't say, well, here's my bullish case for equities. The economy is strong, unemployment is low, and there's $6 trillion sitting on the sidelines. That $6 trillion in that statement is being attributed to being on the sidelines of the equity market field. That's simply not true. I don't think that there has been a time that I haven't heard that excuse trotted out, no matter what has been going on. You know, the other excuse is hedge funds are underperforming their indexes. Hedge funds typically don't have indexes. Their indexes are a cash rate plus a spread for a true hedge fund. So, you know, it's like a real estate agent, you know, telling you this is an up-and-coming neighborhood. It's never been a better time to buy. Whenever I hear these analysts trot out that excuse, there's a lot of money on the sidelines, I think. You're basically out of ideas of why the equity market's going to go up. So you're trotting out this old idea. So a big chunk of this $6 trillion doesn't belong to the bond market or the equity market. What does belong is split between the equity market and the bond market, and it's really not going to move until rates really start coming down, and not just one cut or two cuts. But once you start getting to under 4% on money market funds, 3.5%, then you're going to start see the shift out of money market funds. So it truly isn't on the sidelines. It's probably more in the stands up here. Once rates start coming down, it may move onto the field, onto the sidelines, and then get into the game, but you don't know whose sideline it's going to be on. So whenever you hear an analyst saying there's a lot of money on the sidelines, $6 trillion, you can say, whoa, 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 whoa. Okay, you're out of ideas, because it's not $6 trillion. Next FOMC meeting, March 20th, 31 days away. Probabilities now for nothing at 90%, up from 84%. I think that's the right number. Only 10% weight on a 25 basis point cut. In 3 days. On Wednesday, we get the FOMC minutes in 3 days, and keep in mind, U.S. is closed on Monday. So it's really 2 trading days, and we'll get the minutes. We'll also get NVIDIA's earnings that day as well, so it's going to be a big volatile day because the AI story is the NVIDIA story, and if that performs again, then that AI hype might just, push the market to newer and newer highs. The market did hit another all-time high last week. This week we get Canada, PPI and CPI. 1 day for PPI, 2 days for CPI. Wednesday, Thursday we have some auctions. Wednesday's the 20-year bond auction. It's not a big tenor. It's not a market-moving tenor. And Thursday we get the 30-year tips auction. Not a lot of Fed speak this week. Wednesday you have 2, Bostic and Bowman. Thursday, it's like they booked, everybody booked on Thursday. Jefferson, Harker, Cook, Kashkari, and Waller. Let's go to June. Let's see what's going on June 12th. Big move here. What I've done is I've just said 2 rate cuts or more. This is 2 rate cuts or more. Last week, 50.3% was the probability or the weighting on having at least 2 rate cuts or more. Now that's only 28%, 27.9. No rate cuts went from 7.8 to 18.4, and this is by June. This is by June. And Bostic is saying not till Q3, which means that he doesn't expect anything by June. So the weighting is starting to reflect some of that. 1 rate cut went from about 42% to almost 54%. But this is the big thing here, 2 or more, from 50, over 50% to 28%. Effective federal funds rate still sitting at 5.33. The lag, 75 basis points. Reverse repo, another new low in the reverse repo. February 16th, 5.32. February 9th was 5.69, so it's down 37 billion. February 15th, the Thursday, hit a new low, closing low for the day, 493 billion. Bank term funding program down to 164. Not much, but down slightly. The TGA, 831 billion, and reserves still sitting at 3.5 trillion. I think the number here is 2.5 trillion for ample. Ample with enough room for the movement from 2.5, because reserves do bounce around. So if they try to target 2.5, figuring you got maybe a 250 billion point band in here. Right, I think that's where they're going to go. So you basically got 532 and roughly about a trillion. So you got about 1.5 trillion that could happen in runoff. But with the minutes this Wednesday, that's what I'm going to be looking for. What was the conversation around the balance sheet runoff? And are they starting to project when they're going to start talking about tapering? Because if there is language in it, then the March meeting just got a little bit more interesting. Okay, maybe no rate cut, but they might have something to say about the balance sheet. Real yields all increasing a little bit. The 10-year threatening the 2% level. 3 more basis points to go. Looking at Fed funds futures, going out to April now, 5.305 is the implied rate. The Fed funds, the effective federal funds rate is 5.33. Implying we have a meeting in March, implying that by the end of April, which is a clean month, no meeting in April, that no cuts. Going out to the end of June, the implied rate is 5.115, down. The Fed Fund futures is down, so the rate is up 9 basis points. Going to the end of September, the implied rate 4.795, and by the end of the year 4.46. So by the end of Q2, the market is pricing in 21.5 basis points of cuts. Q3 another 32, and Q4 another 33.5. That's 87 basis points in total, which is about 3.5 rate cuts versus the Fed at 3. Last week I had mentioned the market's at 4, the Fed's at 3. I don't think there's very much left in terms of arbitrage for this, so I'd be comfortable selling puts on TLT. I still feel comfortable selling puts, even though TLT is below that price. The premium you got was more than where TLT is in the price right now. I do feel confident that TLT can finish above those strike prices by the March expiration. TLT, again, not a very good week, down 1.16%. SPY down ever so slightly, 0.42. No implied volatility on the 13-week, 0. Even going out to 52-week, you're at 10% on TLT. So just to judge the value of the options, I took the next regular expiration, which is March, 27 days to expiration. This is an at the money, so you're basically selling a 93 put. And I'll be comparing the at the money puts to a number of different underlyings as we go forward. $1.53, 1.65%, which is a 22.25% annualized rate. That is really low, 1.65%. So if it is put to you, you're getting it at around 92.47. I think that's a good number right now, being that the market is 3.5 cuts. The Fed is 3 cuts, and you have Fed speak that's kind of mixed between the two. Some saying, oh, it won't be till later in the year. Some saying, no, well, we got, if you're looking at the 3 and the 6 month, our targets are being met. I think we're as close to arbitraging this as you can get. I'd be comfortable with the 93 at the monies at $1.53. Okay, over to housing. Housing is getting a little boring. I think the big gains in housing have been done for now until the Fed starts lowering rates and mortgage rates really start to break down under 6.5%. I think we have a sideways market in housing. Long term, I'm still a big fan of U.S. housing, but in the short term, I think the gains have been done. So it might be a nice place to start thinking about income strategies like selling puts on some of the home builders. I don't know that there's much downside to them, but I just don't see a lot of upside. So if you are holding long positions, you might want to start looking at 20, 25, or 30 delta calls. 6.77 on the 30-year FRM, up 13 basis points. 10-year Treasury went up 9 during that period of time, so the spread increased by 4, up to 253. You can see the housing stocks here sort of mixed, and the housing ETFs slightly negative, in sympathy with the S&P. This is the big mover over the last week, 13.46% increase on ABR. They had earnings performed. It was audited. The fourth quarter is audited. No red flags. We don't have the full 10K and quarterly report. We don't have the full SEC report yet, but nothing really came up on the conference call. Ivan Kaufman did mention the short reports after his presentation. He said, let me take a moment and address the numerous short reports that have come out about our company. And he says, I'm not going to engage in a back and forth on point by point. I'm just going to highlight some big themes that they're all getting wrong. And it seemed to work, because while the press conference was going on, the price of Arbor went up, not down, went up. Book value per share of 13. In the Q&A, there was some talk about the December 31st delinquency rate of how many people are 30 days plus versus end of January, and they made a point saying, look, it's really come down by the end of January. 30 days plus that are late on their payments, lower at the end of January 24 versus December 23. And they did mention that with the yield curve where it is, where the 10-year moving up, they're going to be challenged for the next 2 quarters. And if the Fed is pushing its first rate cuts into the third quarter, they might be challenged into the third quarter. But they did mention, look, we've been challenged for the last year. We've raised our dividend twice, generating free cash flow and maintaining our book value per share. So they feel they can get through the next 2-3 quarters. Mentioning the 10-year under 4% is a critical number for them, that things start to get a lot easier with a 10-year under 4%. So if we're looking for some sort of one data point in the market that can make us happy or sad on ABR, I guess it's just watching where the 10-year yield is. The closer it gets to 4%, the easier it gets for their business model. Mortgage apps for February 9th down 2.3%. This is a positive for housing. The housing market index at 48 versus 44 on the previous read. Building permits for January up 0.3, but not good here. Housing starts for January down 14.8%. That is not yearly. That is month over month, down 14.8%. Spreads, OAS, credit spreads, just uninterested in anything, contracted right across the board. You have the IG under 100 basis points. High yield has been under 500 basis points for a long time. Why do I say 1% and 5%? To buy protection on credit risky bonds. When you buy protection, the premium for IG is 100 basis points. And the spread is below the premium. For high yield, the premium is 500 basis points. The fixed rate on the CDS is 500 basis points. It's been under that for quite some time. Rather uninterested in anything that's going on. So I think if we think about credit and the rest of the overall market, adding a factor that gets you credit exposure, looks like it has basically zero correlation with the rest of the market. Okay, CPI, and TLT was down 1.7% on the day. And it was this report. If you look at a chart, an intraday chart for TLT at 8:30, you see a big drop down based on the release of CPI. All items 0.3, and all items less food and energy 0.4. And you can see the trend from July to January: 2, 2, 3, 2, 3, 3, and then a jump to 4, a spike up here to 4. And trying to find where it comes from here. We have commodities, less food and energy commodities, and this has been on a negative trend for a while. We look at new vehicles, 0, 0.2, 0.2, negative 0.1, 0, 0.2, 0, it's not there. Looking at new used cars and trucks, negative 3.4. Apparel, negative 0.7. Medical care commodities, negative 0.6. It's when you get to services, less energy services, 0.7. Three big ones here: shelter at 0.6, with Case-Shiller pretty much at all-time highs. The housing price index at all-time highs. I'm not sure that this is very surprising. Transportation services up 1%, medical care services 0.7. So the 1%, I thought, well, let's have a look at some components. A weighting of 6.3%. Repair, where the big price increases for transportation came, auto repair, insurance, parking, and fees to register a vehicle, state and federal fees. So the government is contributing to some inflation by raising fees there. And then public transportation, which of the 6.3% has a weighting of 1.07 of that 6.3. Public transportation up 1.3% month over month. So something going on in transportation. For shelter, if we look, as I said, look at the Case-Shiller housing price index for November, came in at 312,146. The October reading was an all-time high on the Case-Shiller at 312.7080. So you can see we're still just a little bit for November, just a little bit below an all-time high. Now here's a conundrum. We know that lower interest rates, if you drive interest rates down very, very low, you will get a whole bunch of existing homes coming onto the market, because homeowners will say, well, you know, I can upgrade to another house and I can sell this house, this lower priced house, upgrade to another house without having to get out of a 3% mortgage and get into a 6.5% mortgage. But if you drive interest rates down, you drive housing prices up. So you can increase supply onto the market by lowering interest rates, while at the same time most likely raising prices. So the question would be, would the amount of homes that then hit the market, would the increase in supply outweigh the inverse effect on price and interest rates that we typically see in the housing market? But as long as interest rates are high, and housing prices continue to hit all-time highs because existing homes just are not hitting the market because supply is low, how do you solve that without perpetuating it? It's an interesting thought experiment of how you actually solve that. Will higher interest rates or this level of interest rates for longer fix that problem? I can't see how it would, because it doesn't induce construction. With interest rates this high, why would any builder build a spec house? In other words, why would they go into a development and build 50 houses for inventory? Just spec houses, just based on traffic flow coming through. Don't worry, we'll build it, they'll sell it. People will come and buy it if we build it. So you actually are keeping supply down in two ways. Investment in spec houses and 30-year fixed rate mortgages have immunized homeowners from interest rate increases. Why would the only way they feel the higher mortgage rate is if they sell their existing house and buy another bigger house, upgrade to another house, and pay that higher rate. So this might be a point of discussion at some point, that look, we see progress in a whole bunch of different areas. Labor has 4 to 5% wage growth, but productivity is just as high. So unit labor costs are well below 1%. The second quarter they were negative, the third quarter they were 0.5%. So that's not really an issue. It's this issue, but high interest rates cannot solve this, and low interest rates may or may not solve it. Think about that. Interesting. Here's PPI, and on the day, TLT was down 0.579. We look at this is final demand for goods, final demand for services. We go to the last column on each one, down here, sorry, on each one. This is less foods and energy, so total food, energy, less food and energy, 0.3. You know, if you look at what has been going on over the last little while, 0.3, yeah, you had a 0.1, 0.1, 0.1. It is a step up to 0.3. It's not as if you had 0, 0.4, negative 0.2, 0.5. It didn't have this kind of volatility. It was rather benign, so yeah, it is, you know, a point to look at. This is a big one here, 0.8, final demand services. And if you look at this particular series, this goes all the way back to January 2023, blew them all away at 0.8 on the services. Change in final demand from 12 months ago, unadjusted, 0.9. Change in final demand, less foods, energy, and trade from 12 months ago, also unadjusted, 2.6. Here it is here, and that's the same thing we saw in CPI, that the hot reading on CPI for the core was primarily from the services side. We're seeing it on PPI as well. That is a big number. I don't know that you can sort of look past that and say that's an anomaly. If it was like 0.4, it'd be like, well, that's within the last 13-month range, or sorry, the last 12-month range. That's fine, but this is way outside of the last 12-month range, and yields did not like that. And retail sales. Now this is just generally an ugly report. Here's January 2024 from December 2023, month over month, negative, 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 negative. Look at all the negative signs all the way down. That is not a good report at all. If we look at year over year, 2024 over 2023, you got a bunch of negative signs in here as well for retail sales. Year over year, a little bit more mixed, but still a lot of negative signs in there. The month over month is just not pleasant at all. When I combine that with housing starts being down 14% month over month, that's just not pleasant. But for some reason, this is Thursday, TLT up 0.52, SPY up 0.69. Yeah, is what the market said. And I think they were still partying from Wednesday. Goolsbee, who downplayed the 1 month hot reading on CPI, saying, look, you know, you got to look at the 3 month, the 6 month, the 12 month. They're all coming down to our target. We are achieving our goals. And the market really liked that on Wednesday, just on the strength of that. TLT 0.51, SPY 0.91. And I guess they liked it so much they carried it into the next day and did it again without regard to the retail sales report. There is no way of saying this any other way than it was ugly. It wasn't as if it's like, well, where's the silver lining? It was just an ugly report. So this is why I think, given that the market seems to have responded more towards Goolsbee, and then even the next day with retail sales, you still had the carryover of the excitement of that statement. I think the Fed and Fed speak and rates are still firmly in the driver's seat on this one. I had put them in the passenger seat for a while, on the front seat, but certainly passenger, that the economy would be more important. And last week I mentioned that I might be ready to put them in the back seat because it just seemed like the volatility was just sort of disappearing. The market was expecting rate cuts. The Fed is mentioning rate cuts. We all seem to be on the same page, and the stock market is just saying, okay, let's start going. We don't need to wait for this. It's a done deal. To just ignore retail sales, to reverse the CPI sell-off and celebrate based on what seems to me one person's statement irrespective of what happened Thursday, and for the S&P to hit a new all-time high closing on Thursday on the back of this. I don't know. Are we whistling through the graveyard here? I'm pretty sure I said that wrong. Whistling past the graveyard. But I guess if you're walking through the graveyard, that's got to be worse than walking past the graveyard. And if you're still whistling, well, I guess it's the same thing. Forward 4-quarter operating earnings, 242.57, slightly down from last week, but nothing to talk about. For SP Global, unchanged. So I checked the dates to make sure I had the right spreadsheet. I did, just unchanged. So taking the average of the two, using the closing SPX of 5005, we're 20.72 on the forward multiple versus 20.81. 13-week implied volatility. Looks like we got a lot of volatility, 94%. We're way down here. It's just that if you go back 3 months, it has been so low that, yeah, for the last 13 months it looks good, but over the last 52 weeks, below 58% of the readings were above. So just to see what kind of premiums we have here, take a 27-day to expiration at the money. Put 567 is 1.14% or 15.38% on an annualized basis. TLT still has better return on the at the money put than SPY does, than the equity market does. And here again on Thursday, February 15th, we hit an all-time high of 502.01. While we had information that retail sales sucked, that the UK and Japan are in a technical recession. UK, all right, that's a little bit more damaging. Japan, you got to put a little pin in that. Let's see if I can draw a pin. There, that's the head of the pin. You got to put a pin in that one. And I've mentioned this before, that when you have populations that are expected to shrink, you need a new measure of prosperity. And I think GDP on a shrinking population, it's hard to continue to get growth. So that you have to look at it in a different way, that probably growth per capita is probably what you want to look at. I didn't do the numbers to see what growth per capita is, but at a high level, UK, Japan in a technical recession, CPI, PPI coming in hot. Retail sales suck, and market hits an all-time high before the PPI report, an all-time high with like almost no volatility. Corporate spreads don't care. Equity market volatility is almost non-existent. Everything is fine, and I don't know. To me, it just seems there seems to be something missing. Are we simply just ignoring things and just hoping for these rate cuts, that everything is premised on the rate cuts? Now, in defense of the equity market, Q4 earnings for 2023 came in good. They came in, it wasn't as if we were saying, okay, well, the earnings are not materializing, they were overestimated. They came in good. They came in most cases, better than expected. However, revenue growth was below nominal. If we think about nominal GDP, revenue growth was below that for the 500. And most of the earnings was on efficiency gains, meaning we're laying these many people off, we're cutting costs over here, we're doing this. Those run out after a while. Look at this. We'll talk about negative correlations coming back in. Year to date, SPY is up 5.68%. TLT is down 5.65%. I don't know that you could have found better hedges than that year to date. Almost exact on year to date. Wednesday we have NVIDIA. That's I think that is a big deal. Wednesday we have the Fed minutes, but NVIDIA is a big deal because if we go back to last year at this time, it was the Q1. It was in April or early May when NVIDIA really kicked off the whole AI thing. And now every company says AI somewhere in their earnings, even if they mean predictive regression. They're now calling it AI. We've had predictive analytics for years, but that's not sexy enough. It's got to be called AI. If they knock it out of the park, that story becomes very much alive again, and yeah, that could overwhelm any negativity about the Fed staying higher for longer, and that could just simply drive the market higher. Year to date, they are up 50.75%. I'm doing this, it's February 18th. Year to date, I'm talking January 1st. 49 days. Well, not even 49 because I'm February 18th. I'm counting the weekend. You got to count it just till Friday because that's the Friday price. 47 days, this thing, after running to $520, is up another 50.75%. I mean, it's in there. Take the 27-day put, the at-the-money put, just to look at its percentage, 6.62. Versus SPY at 1.14, 6.62. The straddle, the at-the-money straddle, as of Friday, is 13.72%. It's almost $100, which I think looks like a good opportunity because NVIDIA is sitting at 727, up 51% this year. Growth being priced in, I think, quite aggressively. On earnings, do they have a $100 move? Because if you sell the straddle, you're getting almost $100. Your break even is $100 higher or $100 lower. Did they move $100 on earnings? I don't think they have before. So even if they move $40 on earnings, the next day you get the IV crush, where implied volatility drops out of the straddle very, very quickly. The last reading on IV, 60.8%, 61% IV. I'm not going to do it, but I would seem to think the short straddle on this pays. We don't know what the at-the-money strike is, and you certainly wouldn't do it until you had to. Like I wouldn't do, if I did it, you don't do it Monday morning because IV will increase a little bit more going into earnings, and the price will move, and you want the at-the-money straddle. The price may go to 635, and that's where the at-the-money straddle is, or it may drop, 635, 735, or it may drop to 710, and that's where it is. So you want to do it, minutes before the market closes so that you get as close to at-the-money as you possibly can. But I think the straddle pays because it's a big number. Having increased roughly 51%, sitting at 1.8 trillion, does it have a $100 move on earnings, being that so much has already been priced in? I don't think so. I think the short straddle pays. I'm not going to do it. I'm not going to do it because I can get my kicks in other ways. I want to sleep well, right? I'm not going to do it. But on a paper trade, on just a friendly side bet, I think the short straddle pays. We'll find out. A couple other interesting ones, GM and AT&T, they're not going anywhere. They're not going anywhere. But that doesn't mean there's no trade. AT&T actually has a very nice trade set up, even though I wouldn't think that it's $17. Is it going to $25? I don't think so. 27-day to expiration put, 17 put, 2.23%, double what SPY has. And AT&T has a 6.5% dividend yield. The 17 call is at 41. Selling 17 puts, I don't see them much below 17 given that dividend yield. I don't see them much below 17, but I also don't see them much above 17. That if I were going to set up a nice income factory on this one, I'd be selling 17 puts, and if they're put to me, I would turn around and sell 17 calls on them. And let them be called away and keep selling 17 puts. If they're put to me, keep selling 17 calls. That's a nice income generating strategy. And while I'm holding it, if I do hold it at dividends time, it is a 6.5% yield on the dividend. So you could, be long 100 shares of AT&T, and you can continually sell the $17 calls, or even go up to the $18 calls every month and sell them. You could double, maybe even triple that dividend over the course of the year. GM, same thing, 27-day to expiration, $1.11, 2.87%. They just did their accelerated share buyback, and the market's not going to respect them. They haven't gotten any respect for a long time. Their leadership needs to change. Mary Barra made some very critical mistakes. She should have spun out Cruise 2 years ago when it was hot. She should have spun it out. Now they're not investing in it anymore. They pull back their cash expenditure for Cruise, which makes their cash flow from operations or their free cash flow significantly higher. That is a $50 billion opportunity that is just gone. And Cruise would have IPO'd at a market cap greater than GM's and blew it. Just blew it. GM needs new management. But what they're going to do is they're going to keep buying back shares because they have a free cash flow yield that's off the charts right now. I think their market cap is selling for less than 4 times their free cash flow yield, which means next year they could do another $10 billion buyback, and the next year another 10. And within 3 years, they could buy it all back. 3 or 4 more years, they'd buy it all back just on the free cash flow. So I would be looking at GM 37, 36 puts. Anytime GM shows some weakness in the market, I'd be looking at the 37s to 36s. Only because I do believe that the only way they're going to get their share price from $38 to $48 is another $10 billion buyback. The market's not going to give it to them. It's gonna be another buyback, and if they all want their bonuses, they're gonna have to. I also think sometime in the next year or 2 years, you probably will have a management change at GM. It's just in today's climate, in today's political and social climate, it is very difficult to fire a female CEO, especially of a more traditional old world type economy company like a car company. It's going to be very difficult. The optics of it aren't going to be great, but I think she needs to go, not because it's a she, but because of the boneheaded decisions, in my opinion, boneheaded decisions that were made. But that does not mean there isn't a trade. I believe there is a trade at the $37, $36 puts whenever it shows weakness. And AT&T, I think 17 puts. If it's put to you, 17 calls. And I think you could just roll that over every single month. And even if you hold the underlying shares and they're never called away from you, it's a 6.5% dividend yield on AT&T. 3 big networks, TELUS, AT&T, and Verizon. When we're looking at fiber, we're really looking at AT&T and Verizon. The network's not going away. And there are no up-and-coming new companies that can simply just replace that kind of network. I mean, that is decades in the making. It is a barrier to entry big time. Any new player is going to lease capacity from these guys. So they're very deep value. They're not going away. I don't think they're going to go much lower in price. They're trading at very low multiples with very nice big fat dividends. And they have option premium. Not a lot. Again, the 39 cents you get on the 27-day for AT&T at $17 represents 2.23% over 27 days. You can calculate what an annual rate on that is. But look at where SPY is at $1.14 at the level of the market with a forward multiple of 20.72. AT&T's forward multiple is, 8 right now versus 20, almost 21. And with option premium that on a percent basis is double what the market is. You don't have to get these sexy, excited companies and play in the high volatility range to generate income. That's a nice little one to generate income on because it's not going anywhere. Same with GM, it's not going anywhere. Anyways, there's our week ahead. Our big event, in my opinion, the big day is Wednesday. NVIDIA earnings and the minutes from the Fed, and I give the advantage for volatility to NVIDIA earnings. I'll do my Q&A midweek, and we're back on our regular schedule.